You know, there's a massive shift happening in the world of finance, and it's one that most of us have never even heard of. It's this colossal, multi-trillion-dollar industry that's been growing in the shadows, and it's quietly changing how money moves around the entire globe. We're talking about private credit. And when you start digging into it, you see this term pop up everywhere: shadow banks. Honestly, it sounds like something straight out of a financial thriller, doesn't it? It gives you this sense of a huge, unregulated system just operating out of sight. And that, of course, raises a really big question. Yeah, what exactly are they? That is the central mystery we are going to unpack in this explainer. What are these things? Where on earth did they come from? And, should we be worried? Let's dive in. Okay, so to really get our heads around this whole phenomenon, we first need to get a clear definition of what we're actually talking about. What is this new financial powerhouse? So, at its core, it's actually pretty simple. Just imagine a company needs a loan. But instead of going to a regular, old-fashioned bank, they get that loan directly from, say, a huge investment fund or an asset manager. The entire deal happens privately, completely away from public markets. You can almost think of it as a parallel lending universe. So, where did this parallel universe even come from? Well, its origin story, and this probably won't surprise you, it all starts with a crisis. Right, so cast your mind back to 2008. The financial world basically implodes. After that crash, regulators step in to make traditional banks way safer. They bring in all these strict new rules that force banks to hold more cash and take a lot less risk. Now, that was great for stability, for sure, but it also meant that banks just stopped making certain kinds of loans. This created a massive funding gap, and an absolute army of these non-bank lenders, the private credit funds, swooped in to fill that void. And boy, did they fill it. They didn't just plug a hole, they built an incredibly powerful new money machine. So let's take a look at why this new model became so wildly successful. Okay, let's really break down the difference here. On one side, you've got traditional banks. Think slow, bureaucratic, wrapped up in red tape. They're heavily regulated and they hate risk. On the other side, you have private credit. They're the complete opposite. They are fast, they are flexible, and they operate with very little regulation. And that allows them to take on the very risks that banks are now forced to avoid. That agility, that is their superpower. So who really wins in this new setup? Well, at first glance, it kind of looks like everybody does. Borrowers who got turned away by banks, they get the capital they need. Investors like big pension funds, they get much higher returns than they could find elsewhere. And the wider economy gets a nice little boost because money is flowing to all these mid-sized companies. On the surface, it really looks like a perfect financial engine. And we are not talking about some small niche corner of the financial world here. This thing is a behemoth. We're talking about a market worth over $1.5 trillion, and it is growing incredibly fast. That sheer scale is what turns it from just a clever alternative into a really important part of our global financial system. Which, of course, brings us to the trillion-dollar question. Whenever you have a system this big, this fast, and this unregulated, there's got to be a catch, right? And yep, there is. Because the very things that make private credit so appealing, its speed, its flexibility, its freedom from the usual rules, well, those are also the source of its greatest risks. Think about it. Without those bank-style safety nets, there is nothing to cushion a fall. First off, these deals are super opaque. It's really hard for anyone on the outside to know the true value of the loans because the funds can basically use their own models to price them. Some experts worry that if a borrower gets into trouble, a fund can just quietly rework the loan without telling anyone, making a bad asset look perfectly healthy on the books. Second, the quality of the loans can be pretty shaky, often going to companies that are already deep in debt. And finally, and this is a big one, these funds are deeply connected to the regular banking system, which gives them lines of credit. So you can see how a problem in one could quickly become a problem for all. And this really gets to the absolute heart of the problem. These private credit funds are acting like banks. They're creating and managing massive amounts of debt, but they're not regulated like banks. It is a classic case of what people in finance call regulatory arbitrage, just finding and exploiting the gaps in the rulebook, but doing it on an absolutely colossal scale. So all of this leaves us facing a massive uncertainty about the future. What happens when this shadow system faces its first real test? Well, that test, it's happening right now. For the last decade or so, money was cheap, which made it pretty easy for companies to pay back their loans. But now, with interest rates so much higher, a lot of these borrowers are really starting to feel the squeeze. We are about to find out in real time just how tough this system really is.
And this really leads us down two very different paths for the future. In the best case scenario, private credit makes our whole financial system more diverse, more robust. But in the worst case scenario, a crisis in this shadow market spills over and threatens to bring down the whole regulated banking system along with it, just like we saw in 2008.
So what is it? Is it a brilliant innovation that's fueling our economy? Or is it a ticking time bomb built on hidden risks? The honest truth is, right now, nobody knows for sure. And that uncertainty, well, that's the real multi-trillion-dollar question.